The stock market is experiencing significant shifts as key players lead the way in a narrow rally. From inflation data impacts to energy price concerns, the financial landscape is evolving rapidly. Here are today's top 10 stories you need to know. Market volatility has been on the rise, reflecting the ongoing uncertainties in the economic environment. With fluctuating stock prices and mixed signals from various sectors, investors are facing a challenging landscape. This increase in volatility can be attributed to several factors, including geopolitical tensions, inflation concerns, and shifting investor sentiment. As market conditions become more unpredictable, traders may need to adjust their strategies to navigate potential downturns. Analysts are urging caution and recommending that investors stay informed about economic developments that could impact market stability. Going forward, market participants should remain vigilant, as the potential for increased volatility could lead to significant price swings. Understanding the underlying factors driving this volatility will be essential for making sound investment decisions in the coming weeks. Sector rotation remains a prominent theme in the current market environment, with various sectors exhibiting different performance patterns. Recent trading sessions have seen funds moving into sectors like technology and financials, while others like utilities and consumer staples have lagged behind. This rotation indicates that investors are actively repositioning their portfolios in response to changing economic conditions and sentiment. While sector rotation can provide opportunities for growth, it also adds a layer of complexity for investors trying to navigate the shifting landscape. Analysts are cautioning that these rotations may lead to heightened volatility as sectors react differently to economic data releases. As the market adjusts, staying attuned to sector performance will be crucial for making informed investment decisions moving forward. Investors should prepare for potential fluctuations as the market continues to evolve and sectors undergo shifts in leadership. Small-cap stocks have started to gain attention as investors look for opportunities outside of the large-cap space. Recent market activity suggests that there is growing interest in high-volatility small-cap stocks, with several names making notable gains. This shift indicates that traders may be seeking to capitalize on potential growth opportunities amid a backdrop of uncertainty. While small-cap stocks can offer higher returns, they also come with increased risk, making them a double-edged sword for investors. Analysts are monitoring this trend closely, as a sustained rally in small-cap stocks could signal a broader recovery in the equity markets. However, if this interest is short-lived, it may lead to increased volatility. As the market continues to evolve, small-cap stocks will remain a focal point for investors seeking to diversify their portfolios and tap into emerging growth potentials. The current market outlook is characterized by cautious optimism as investors weigh the potential for growth against prevailing economic uncertainties. Despite the recent gains in large-cap stocks, concerns linger about whether this momentum can sustain itself across broader market segments. Analysts are emphasizing the importance of market breadth, urging investors to look for signs of strength not just in mega-cap stocks, but also in smaller and mid-cap companies. If the market can broaden its leadership, it could signal a more durable recovery. However, if gains remain concentrated among a few major players, the risk of a sharp rotation increases, especially if inflation or interest rates take an unexpected turn. As investors prepare for upcoming economic data releases, including inflation reports and labor statistics, the overall sentiment remains cautious. The interplay between growth prospects and inflation will be crucial in shaping the market's direction in the coming weeks. Investors should stay informed and be ready to adjust their strategies based on new information. As the earnings season approaches, investors are gearing up for significant updates from major corporations. Companies such as Costco, Salesforce, and Nvidia are set to release earnings reports that could impact market sentiment. The anticipation surrounding these reports reflects the ongoing uncertainty in the market, as corporate guidance remains a primary source of volatility. Analysts are particularly focused on how these companies will address inflation pressures and supply chain challenges in their reports. Positive earnings surprises could bolster investor confidence, while disappointing results may lead to heightened volatility across sectors. The earnings reports will also provide critical insights into consumer behavior and spending patterns, especially in the retail and technology sectors. As we await these updates, the market will likely remain sensitive to any indications of economic health or challenges. Investors should prepare for potential fluctuations as earnings season unfolds, along with the insights it brings. The financial sector is experiencing a substantial boost, with major firms like Goldman Sachs reporting notable increases in their stock prices. Goldman Sachs saw an impressive rise of 1.70%, reflecting a broader trend of strength across financial institutions. This uptick is particularly significant as banks and capital markets firms are highly sensitive to interest rate expectations and prevailing market conditions. The participation of financial stocks in the current market rally indicates a growing optimism among investors regarding economic recovery and potential deal-making activity. Furthermore, as inflation data is released, the financial sector could encounter increased volatility based on market reactions to these figures. Analysts are closely monitoring the interplay between interest rates and financial performance, as these dynamics will shape the future trajectories of these firms. Looking ahead, the financial sector's performance will be crucial in determining overall market direction, particularly as earnings season approaches and key economic indicators are unveiled. Investors should prepare for potential shifts as these developments unfold in the coming weeks. Technology stocks have demonstrated notable resilience recently, with significant gains from major players like Salesforce and Microsoft. Salesforce's stock surged by an impressive 8.47%, reflecting strong investor sentiment towards enterprise spending and software solutions. Similarly, Microsoft saw a healthy increase of 5.45%, indicating robust performance among large-cap tech firms. This uptick comes amid a backdrop of increasing demand for digital transformation as businesses adapt to a post-pandemic landscape. Companies are increasingly investing in cloud services, enhancing operational efficiency and scalability. The recent performance of these tech giants could be signaling a broader recovery in the tech sector, particularly as earnings season approaches. However, analysts caution that while tech stocks are performing well, the overall market breadth must improve for a more sustainable rally. Many smaller tech firms still face challenges, and their performance could impact investor confidence. As we look ahead, the focus will be on upcoming earnings reports from major tech firms, which are expected to shed light on the sector's resilience and long-term growth potential. Energy prices are facing increased pressure amid ongoing geopolitical tensions in the Middle East, particularly following recent conflicts that have disrupted supply chains. These developments are complicating forecasts for oil and natural gas prices, which play a crucial role in shaping inflation expectations across the globe. Historically, spikes in energy costs have led to higher consumer prices, creating a ripple effect that can squeeze household budgets and dampen economic activity. Additionally, rising energy expenses can significantly impact corporate margins, forcing companies to either absorb costs or pass them on to consumers, which could stifle growth. Analysts are warning that fluctuations in energy prices could quickly reshape inflation outlooks, compelling the Federal Reserve to reconsider its monetary policy strategies. As energy prices rise, there are concerns that the Fed might delay easing expectations, which could negatively impact high-growth sectors like technology and consumer discretionary. Investors are closely monitoring these developments as they may influence trading strategies across various markets. The interplay between energy prices and inflation will be a critical factor to watch, especially as we anticipate potential shifts in Federal Reserve policy in the coming months. The leadership of the stock market has shown signs of narrowing, with a few key players driving the majority of gains. Recent reports highlight that stocks like Microsoft, Salesforce, and Goldman Sachs are at the forefront of this trend. This concentration of performance raises questions about market sustainability, as only a handful of companies are fueling the overall upward trajectory. The current state suggests a momentum-driven environment rather than a broad-based rally, often seen in healthier market conditions. While these large-cap technology stocks are performing well, the overall breadth of the market remains a concern, indicating potential fragility. A narrow leadership may reflect a lack of conviction among investors, suggesting that the rally could be vulnerable to quick shifts in sentiment. Many analysts are closely monitoring for signs of a broader advance among smaller and mid-cap stocks, which could indicate a more robust market environment. If leadership expands beyond these few companies, it may signal a more sustainable rally. As we approach the next earnings season, traders will be keenly watching for indications of strength across various sectors, particularly software and financials, to assess the market's overall health and resilience. Expect critical earnings reports to shape market sentiment in the coming weeks. Inflation data has emerged as a pivotal factor influencing market sentiment in recent days. Key metrics, including the Producer Price Index, PPI, and the Consumer Price Index, CPI, are shaping traders' expectations regarding future Federal Reserve policy decisions. Inflation remains a critical concern for economists and policymakers alike, as rising prices can erode purchasing power and dampen economic growth. Investors are particularly attuned to these indicators, as they provide insights into potential adjustments in interest rates that could impact borrowing costs across the economy. The persistence of inflation poses challenges, especially for high-growth sectors like technology, which are often sensitive to interest rate fluctuations. If inflation continues to exceed expectations, it may delay the Federal Reserve's easing measures, creating a more volatile investment landscape. Conversely, signs of cooling inflation could stimulate risk appetite, benefiting sectors that thrive in lower-rate environments. Analysts emphasize the importance of upcoming inflation prints, as they will directly affect equity valuations and overall market direction. As we look ahead, the trajectory of inflation will play a crucial role in shaping not only investor behavior, but also economic recovery efforts. Investors should remain vigilant, as the next set of inflation data could significantly influence market dynamics in the coming weeks. Thank you for watching. Which of today's stories surprised you the most? Don't forget to like and subscribe for more updates.